to real estate valuation in detail. The income approach to real estate valuation is primarily used for income-producing properties, such as rental properties, office buildings, apartment complexes, shopping centers, and other types of commercial real estate. This approach values a property based on the income it generates or is expected to generate in the future. It is an essential tool for investors looking to determine whether a property is a sound investment based on its potential for generating cash flow. The income approach is built on the premise that the value of a property is directly related to its ability to generate future income. The higher the income a property can generate, the more it is worth. Two main methods of the income approach. 1. Direct capitalization method. 2. Discounted cash flow, DCF, method. Both methods rely on the principle of capitalizing income, but they differ in how they handle future income streams and timing. 1. Direct capitalization method. The direct capitalization method estimates a property's value based on a single year's income. This method is simple and commonly used for stabilized properties that have consistent income and expenses. Formula for the direct capitalization method. The basic formula used is text, property value, frac, net operating income, capitalization rate. Net operating income, the annual income generated by the property after all operating expenses are deducted, but before mortgage payments, taxes, and capital expenditures. It's the fundamental measure of a property's profitability. Capitalization rate, cap rate. The cap rate is the rate of return that an investor expects to earn from the property. It is expressed as a percentage and reflects the relationship between the NOI and the property's value or purchase price. Cap rates vary by market, property type, and the level of perceived risk. Steps in the direct capitalization method. 1. Estimate gross rental income. This is the total income generated by the property from tenants paying rent. 2. Subtract vacancy and credit losses. Account for periods when the property may be vacant or when tenants may not pay rent. A typical vacancy rate might be 5% depending on the market. 3. Calculate effective gross income, EGI, text gross rental income, text vacancy and credit losses. 4. Subtract operating expenses. Operating expenses include property management fees, maintenance, utilities, property taxes, insurance, etc. These are costs associated with running the property, but exclude debt service, mortgage payments, and capital improvements. 5. Calculate net operating income. Text, index, effective gross income, operating expenses. The NOI reflects the property's profitability before taxes and financing. 6. Determine the cap rate. The capitalization rate is usually determined by analyzing recent sales of similar properties in the same market. It's a critical factor because it reflects the risk and return profile of the investment. For example, properties in low-risk, stable markets may have cap rates between 4 to 6%, while riskier investments may have higher cap rates. 7. Calculate the property value. Using the cap rate and NOI, calculate the property value. Text property value, fract, cap rate. Example of direct capitalization. Let's assume gross rental income $300,000 per year, vacancy loss 15.5%, operating expenses $100,000 per year, cap rate 6%. Step by step. 1. Effective gross income, EGI. EGI equals 300,000 minus 15,000 equals 285,000. 2. Net operating income, NOI equals 285,000 minus 100,000 equals 185,000. 3. Property value. Property value, frac 185,000, 0.06 equals 3,083,333. So the property's estimated value is $3,083,333 based on its ability to generate income. When to use the direct capitalization method. Stabilized properties. This method is best suited for properties that have steady and predictable income. For example, an apartment building with full occupancy and a consistent history of income and expenses. Short-term holding period. It is ideal for properties that are not expected to see major changes in income or expenses over the short term. 2. Discounted cash flow, DCF method. The discounted cash flow DCF method is a more detailed and sophisticated variation of the income approach. It estimates a property's value based on its projected future cash flows, taking into account the time value of money. The DCF method is useful when the property's income and expenses are expected to change significantly over time. The property is subject to fluctuating rents, vacancies, or capital expenditures. The investor has a longer-term horizon. Formula for the discounted cash flow method. Text, property value with text, cash flow in year N, 1 plus RN, where cash flow in year N, the net operating income, NOI, in each future year. The discount rate, investor's required rate of return. N, the number of years. In this method, the NOI for each year is discounted back to the present value using the discount rate. The sum of these present values gives the estimated property value. Steps in the DCF method. 1. Forecast NOI. Project the expected income and expenses over a certain number of years, usually 5 to 10 years. 2. Determine the terminal value. This is the expected sale price of the property at the end of the holding period. The terminal value is often calculated using the direct capitalization method based on the NOI in the final year. 3. Select a discount rate. The discount rate reflects the required rate of return for the investor. It usually accounts for the opportunity cost of capital, market risk, and inflation. 4. Discount future cash flows. Discount the projected cash flows, NOI, for each year back to the present value using the selected discount rate. 5. Sum the discounted cash flows. Add the present value of each year's cash flow and the terminal value to arrive at the total estimated property value. Example of DCF method. Let's assume the following projections for a property over a 5-year holding period with a discount rate of 8%. Year, projected NOI, discount factor 8%, present value of NOI, mass 1. 150,000, 1.926, 138,900. 2, 160,000.857, 137,020. 3, 170,794, 134,980. 4, 180,000.735, 132,300. 5, 190,000.681, and 129,390s. Terminal value at year 5. Assume the property is sold at the end of year 5 for $2,500. The present value of the terminal value would be present value of terminal value equals frac 2,500,000, 1.08 square 5 equals 1,701,247. Total property value. The total value is the sum of the present value of the NOI for each year and the present value of the terminal value. Text, total property value, equals 138,900 plus 137,120 plus 134,980 plus 132 good plus 129,390 plus 1,001,247, 2,373,937. So the estimated value of the property using the DCF method is $2,373,937. When to use the DCF method? Properties with variable income? The DCF method is ideal for properties where income and expenses are expected to fluctuate significantly over time, e.g., office buildings with variable leases. Long-term investments. It is particularly useful for investors with a longer-term horizon who expect significant changes in property performance over time. More complex transactions. The DCF approach provides a more nuanced understanding of future returns and risks.